The markets are hitting new highs and everyone seems so confident. But does it feel too good to be true? Are we headed for a crash? Michael Burry, the guy who predicted the 2008 crash, thinks so. Why would someone like Burry sell all his US stocks and invest in China? And more importantly, are we ignoring signs of a much bigger problem? In this video, I'll break down the reasons behind his major moves, analyze the signs he's seeing, and most importantly, show you what to do in this situation. Michael Burry is no ordinary investor. He's the guy who predicted the 2008 housing market crash when everyone else thought the good times would never end. You might remember him from The Big Short, the movie and the book that showed how he crunched the numbers, saw the cracks forming, and bet against the system. And he was right, spectacularly so. What sets Burry apart is his relentless focus on data and his willingness to go against the grain. Most investors chase trends, but Burry challenges the status quo and goes after opportunities others wouldn't dare touch. It's earned him a reputation as a contrarian genius, but here's the problem. His moves are often hard to copy. He takes risks most of us wouldn't take. But when someone with his track record starts sounding the alarm, you'd better pay attention. This time, Burry is stepping away from the US markets entirely and going all in on something most investors avoid: China. Why? And more importantly, what does it mean for you as an investor? Michael Burry's latest portfolio moves show a seismic shift in his investment strategy. His F13 Q3 2024 filings show a clear pattern. He's pulling away from US assets and doubling down on Chinese opportunities. Over the past decade, Burry has made significant adjustments to his holdings, favoring companies he likely believes are undervalued and poised for growth. Michael Burry has been making some bold moves, and it's clear he's not playing it safe. Take JD.com for example. He doubled down, adding 250,000 more shares to his position, which now makes up 24% of his portfolio. That's a huge vote of confidence in a company where many investors are hesitant to touch right now. Then there's Baidu. Burry increased his stake by 66.67%, adding another 50,000 shares. Along with JD.com, these investments show he's betting big on Chinese tech, even as others are shying away. And let's not forget Alibaba. He nearly added 30% more shares, signaling he sees serious recovery potential as China rolls out its economic stimulus plans. Alibaba now makes up 5.75% of his portfolio, further highlighting his belief in these undervalued opportunities. But Burry's strategy isn't just about where he's buying, it's also about where he's getting out. A clear exit strategy from US-based holdings. He's completely exited positions in Hudson Pacific Properties and BioAlta Incorporated, selling off over 1.7 million shares between those two. It's a decisive move that suggests he's losing faith in the resilience of US markets. So, what does this all really mean? Burry's moves point to two big takeaways. First, he sees Chinese markets as a hidden treasure trove for investors who are willing to tune out the negativity and focus on the data. Second, he believes the US market is skating on thin ice, overvalued and overdue for a correction. As US company valuations keep climbing into what looks like bubble territory, Burry's pivot is a clear signal. He's not chasing hype, he's searching for real value, and right now he sees value in China. Michael Burry's warning, "Get out," is backed by numbers that expose the cracks forming in the US market. Burry famously predicted that 2008 financial collapse, and he believes we are once again on the edge of a major correction. The evidence is compelling, and when you look at the data, it's clear why Burry is preparing for what could be the next financial reckoning. To start, valuations in the US stock market are dangerously high. The most glaring warning signs come from the Buffett indicator, a metric Burry has referenced before that compares the total value of the US stock market to the country's GDP, and serves as a glaring warning sign. Today, the indicator is at 208%. an all-time high that dwarfs the 140% peak seen during the dot-com bubble in 2000 and the 110% recorded before the 2008 financial crisis. In other words, the U.S. stock market is significantly more overvalued now than it was before two of the most catastrophic market crashes in modern history. Simultaneously, the U.S. national debt is escalating at an alarming rate. As of 2024, debt levels have soared to 123% of the GDP, up from just 33.27% in 2000 and 63.82% in 2008. This rapid increase is pushing U.S. finances to a precarious position. Rising interest rates are amplifying the cost of servicing this debt, leaving policymakers with fewer options to navigate economic downturns. That's not all. Interest rates have surged over the past 18 months. The Federal Reserve has hiked rates from near zero to over 4%, marking the sharpest tightening cycle in over 4 decades. The consequences are profound. Corporations that relied on cheap debt to expand are now facing refinancing hurdles at much higher borrowing costs. Heavily leveraged companies, particularly those with weak cash flows, are at serious risk as borrowing becomes unsustainable. Beyond these economic fundamentals, speculative behavior continues to distort markets. In the past year, high-risk assets like cryptocurrencies and meme stocks have attracted billions, despite clear signs of instability. Companies trading at excessive price-to-earnings multiples are a hallmark of this irrational exuberance. For instance, Tesla's PE ratio is 120.74, compared to single-digit valuations for legacy automakers. Burry warns that this behavior mirrors the blind optimism seen before the 2008 housing crash, where overconfidence led to catastrophic losses. Meanwhile, the U.S. government is grappling with its own financial challenges. The national debt, now exceeding $36 trillion, has reached its highest level since World War II. Rising interest rates make debt servicing increasingly burdensome, placing additional pressure on federal finances. Political standoffs over the debt ceiling only add to the uncertainty, eroding investor confidence in the U.S. economy's long-term stability. However, Burry isn't just focused on the risks. He sees opportunities elsewhere, particularly in undervalued international markets like China. While U.S. stocks continue to trade at unsustainable valuations, Chinese companies such as Alibaba and JD.com are available at deep discounts. Alibaba's price-to-earnings ratio is just 17.68, a fraction of Amazon's 49.5, while JD.com trades at an even lower multiple of 11.79. Moreover, China's government is actively rolling out stimulus measures, including a massive $1.8 trillion infrastructure and tech investment plan to boost economic recovery. Connecting the dots, the picture is unmistakable. The U.S. stock market is severely overvalued, debt levels are skyrocketing, corporate refinancing risks are escalating, and speculative mania persists. Conversely, undervalued assets in international markets like China present opportunities for those willing to look beyond U.S. borders. Burry's message isn't just a prediction, it's a strategy grounded in data and history. His foresight during the 2008 financial crisis went unheeded, and the aftermath was catastrophic. This time, his warning carries the same urgency. The U.S. market is at its breaking point, and investors must carefully reconsider their next move. Ignoring Burry's call to action might prove to be the costliest mistake of all. However, Michael Burry's strategy of exiting U.S. markets and betting on Chinese stocks is bold, but it's not without its risks and rewards. For investors, understanding both sides of this strategy is crucial to deciding whether it aligns with their own financial goals and risk tolerance. Let's start with the risks. Investing in China comes with inherent challenges, especially for foreign investors. Regulatory uncertainty is one of the biggest concerns. Over the past 2 years, the Chinese government has cracked down on sectors like technology and education, wiping out billions in market value. While Burry sees opportunity in the aftermath, the unpredictability of these policies remains a risk. Additionally, geopolitical tensions between the U.S. and China continue to escalate. Trade disputes, sanctions, And increasing restrictions on Chinese companies listed in the US can add volatility to these investments. Then there's the currency risk. As the Chinese yen fluctuates, it can impact the returns for foreign investors. On the other hand, the rewards Burry sees are significant. The primary driver of his strategy is undervaluation. Chinese companies like Alibaba and JD.com are trading at PE ratios of 17 and 11, far lower than their US counterparts like Amazon, which sits at 49.5. These low valuations, combined with China's economic recovery, provide an opportunity for outsized returns. The Chinese government is also rolling out massive stimulus measures, including $1.8 trillion in infrastructure spending designed to boost domestic growth and stabilize the economy. For investors willing to ride out short-term volatility specifically because of the last crackdown, this creates a compelling case for long-term value. Burry's strategy also highlights the importance of diversification. For investors whose portfolios are heavily weighted towards U.S. assets, adding exposure to international markets, particularly China, can help balance risk and unlock new growth opportunities. Following anyone blindly is not the solution, but understanding why Burry is making these moves can help you think differently about your own portfolio. At the core of Burry's strategy is his ability to spot inefficiencies. In 2008, while everyone was betting on the seemingly unstoppable housing market, Burry noticed the cracks, hidden in the complex financial instruments underpinning the bubble. He studied the data obsessively, identified the risks, and placed his bets against the system. The result? Massive profits when the market collapsed. Today, he's applying the same analysis to global markets. While many chase U.S. tech and speculative assets, Burry is focusing on undervalued Chinese companies, guided by data, not trends or emotions. It's time to rethink your strategy and approach the markets with caution. If someone with his track record of spotting financial crises is warning about overvaluation, rising risks, and speculative bubbles, ignoring him could prove costly. For everyday investors, the first takeaway is to be cautious of overexposure to U.S. markets. Valuations have reached historic highs, and rising interest rates are putting additional strain on the corporate profits and debt. Take a hard look at your portfolio and trim overvalued positions. Second, consider diversification. While the U.S. faces challenges, undervalued opportunities exist in emerging countries like India, Taiwan, or perhaps China, where Burry is investing. Finally, holding cash can be a smart move. Both Burry and Buffett have used this strategy before in the overvalued market, waiting for the right opportunities when markets crashed. Sometimes, patience and discipline are your best tools. The real takeaway, don't just copy Burry, think like him. Question trends, focus on the data, and stay disciplined. In a turbulent market, that mindset could make all the difference. Buffett thinks staggering debt, inflation, and overvaluation might not be the main reasons for the economic shutdown, but that a tariff war might be the primary cause. Click the video on the screen to find out why.